Andrew Malcolm here, and we're going to go through the 3 Property Formula book. I'm going to take you through over a series of videos some of the key concepts from the book, and it doesn't matter if you don't pick up your own copy. I'm hoping to cover what I think is the most important stuff so that you can progress from no properties to your first property, or from your 4th to your 15th property. The strategies that we've gone through in this book are built up from lessons of helping hundreds, well actually thousands of property investors, and we've seen what works, we've seen what didn't work. We've tried to simplify the lessons into a framework that's easily adoptable, even if you already have a portfolio, that you can start to make adjustments. So the 3 Property Formula is all about the philosophy behind it is that what you're trying to do through your wealth generation, your wealth creation process, is to create financial freedom where you've got income for life. And there's a passive income is a bit of a throwaway dirty term, especially on the internet. What you're really trying to do is create a base, a foundation of income generating assets. In this instance, it's property. So when you get to a certain stage in your life, you can stop working, or you can choose to reduce your income generation from your employment or your business, and you can start to enjoy life and start spreading money to areas that generate a lot of happiness for yourself. So the introduction talks a lot about if your current mortgage or the mortgage that you're thinking about getting is going to keep you up at night, it's because you don't yet understand the power of safe leverage and about how debt is helping you build your wealth in a constructive way. So part 1 of the book covers a mortgage reduction strategy. This is when you're more in your earlier stages of investing. So you've already got one property, probably your family home. What you're trying to do is get that first investment property. Even though we treat the family home as an investment, what really creates wealth is when you're getting surplus from investment properties to help pay off your own mortgage. Part 2, we're looking more deeply into property investing, that you're getting your 2nd, 3rd, 4th property, and what we're trying to do is create a portfolio that is really going to enrich your life, not just buying a simple investment property on a simple plot of land that has 3 to 4% return. What we're trying to do is talk about development potential properties, properties you can add extra bedrooms or dwellings, things with more hidden value, more creativity required. And that might be renovations, for example. So part 1, we're talking about 3 things you should stop doing today that will shred 10 years off your mortgage, how to ease your financial stress without and worries using a spending blueprint, how to get your equity working so you can pay off your mortgage 10 years sooner, choosing an investment property using the 3 C's, which obviously we've covered in other videos, but that's your cash flow, capital gains, capital allocation strategies, and then we're summarizing. And throughout the whole book, we've got a lot of, here's an example, case study, Joe in Christchurch with a gross yield almost 7%. He's high income, high equity earner, and it just breaks down that property. So there's a lot of case studies in the book as well. So part 1, in the next video, I'm going to go through in the introductory chapters what the 3 property formula is, and talk about some mental models to help you think more constructively about your investing. So what is the 3 Property Formula? Well, the 3PF, the 3 Property Formula, is a mindset. It's a financial freedom framework. It's a simple model, buy 3 investment properties that will help you stay on the pathway to achieving financial freedom within a reasonable time frame. The thing is, there's a bit of a challenge for most investors. Most people don't have a hugely successful business that provides them with lots of capital and income forever. Most people, if they do have a business, have a modest business, might earn them $100,000, $200,000 or $300,000 a year, but that business is attached to them working. And if they don't have a business, they have a salary, and that salary requires them to be, again, there working, earning the money. So what we're trying to do through the 3PF is create income for life. And I don't like to use the word passive income because it's so tarnished because of the internet marketing, but that's what we're trying to do. We're trying to create as most passive income as we possibly can through investment property, understanding that there is going to be work, there are going to be tenants that are annoying, there are going to be property managers, there's going to be lawyers, there's going to be agents, there's going to be mortgage advisors. There's no real such thing as a pure passive income unless you've got millions of dollars put into the share market, providing you with dividends, and then even then you're still going to have to choose an active manager or manage the shares yourself. So what we're trying to do is give everyday Kiwis access to financial freedom in a meaningful way, whether that's 20 grand extra a year or 200 grand extra a year of income for life when it's time to wind it back on the work side of things. So the important thing for the 3PF is to remember that mortgage debt in particular is an intelligent tool to help you build up your investment and to build up your financial freedom. What you will never be able to do without debt is to get to your 3, 4, 5, 6 investment properties, because you simply can't save enough. Unless you're earning $1 million a year, you're gonna need to use debt to get the investment properties. And if you've got $1 million of debt and that $1 million cost you $50,000 a year in interest repayments, but you're getting $80,000 a year in rental income, then you've got a big surplus that if you miss any payments are not made, or you have a period of time where you need your renovation, you're never in a long period of time where your cash flow is negative. So what are we big proponents of here? We're very much in favor of positive cash flow. Now that doesn't mean that we're talking about investing in Invercargill all the time. There's no problem with that. But what we're talking about is having a nice balanced approach of cash flow, capital gains, and improvement, or at least finding good opportunities for development or subdivision or value add. What we're trying to teach you through this framework is intelligent investing. And it's not because we're geniuses, it's because we've helped thousands of homeowners, thousands of property investors over the last 7 years. We've seen what works, and we've simply condensed down the successful case studies and the successful strategies, and we've also included the mistakes. So the 3 property formula is a mindset, it's a framework for building up wealth, and it's important that you're not scared of debt as long as it's structured well and it's debt for an intelligent purpose. Now, what I want to touch on next is the Dunning-Kruger effect. Now, let's take a minute to address your mindset. The Dunning-Kruger effect is about ego, so it's important that we establish what it's about and what our mindset needs to be before we jump into the mental model. So I'm going to read it. All right. We've all met someone who has learned a little bit about a particular subject and then suddenly they're an expert. Things like DIY, politics, cryptocurrency, they breed overnight experts. A little bit of knowledge goes a long way, and it goes too far in many cases. This is known as the Dunning-Kruger effect. So the Dunning-Kruger effect has on one axis the confidence level and the other axis is competence. So competence meaning how good are you at the thing that we're talking about. Now what most people fall into is they think, oh yeah, I know a little bit about property investing. I know how to do a renovation. I know what's a good property and what's not a good property. And what ends up happening is they get extreme confidence, but in reality, their competence level, their expert level is actually relatively low and they don't realize it. And what gets them in trouble is that they think they know, and this prevents them from listening to experts, listening to others that they should consider their ideas. It prevents them from assessing their own opinions, challenging themselves, realizing that they might be wrong on a few things, and making improvements or changes. Now, what you really want to get to is get to a point where you're humble, have some humility, and to say, you know what? How much do I actually know about mortgages? How much do I actually know about property investing? Could I teach a course on it? Could I take $1 million and turn it into 10 million over 10 years? Confidently, I want, even for the successful investors that have 3, 4, 5 properties already, to just sit in your seat and relax and to take a deep breath and say, you know what? Maybe I've got something to learn because I've been stuck on my current property portfolio for a while. My cash flow is not as strong as I thought. My debt costs are actually going up. And I'm a little bit worried about the market. Maybe I actually need to know more. Now, we help people that have 10 plus properties and they still come to us for advice because they know they don't have all the answers. So if you're not at 10 properties yet, I'm pretty sure, even myself included, there's a lot to be learned through applying a little bit of humility and going through this valley of despair right here and getting myself in a position where I'm saying, you know what, I'm going to start in my mind with a blank slate as much as I can to learn about property investing in today's market. You know, property investing in the 1970s, 1980s, 1990s was very, very different. The finance rules were different, the prices were different, the real term income to property values ratios were very different, the zoning laws were different, the tenancy laws were different. There's been so many changes that if you're still investing in 2022, 23 with a 1990s framework, then you're probably going to get yourself caught up. So whatever the case, what we're trying to do is we're trying to learn, and it cannot hurt to have other perspectives. And that's what the Dunning-Kruger is all about. It's about staying humble and saying, you know what, I couldn't write a book about this. I couldn't teach a class of 100 people about this. I need to learn more. I need to walk before I run. So part 2 of the book, we're looking at your mortgage expansion strategy. This is when we're looking at deep diving into the 3 property strategy. What happens to a lot of investors is they buy one investment property and they get stuck. So what we're trying to do is right from the beginning of your investment journey, we're getting you prepared and getting you into position with knowledge that you can keep investing a lot sooner than you would. You don't want to be buying 3 properties over 30 years if you can be buying 3 properties over 5 years, because obviously you get the cash flow and the gains a lot quicker the earlier you get that portfolio built up. It's really important. In part 2 we cover the mortgage coverage strategy, which again addresses the monkey in the room. How do you get the money to buy investment properties? You need to make sure that your yield from mortgages is covered so that the bank or any property investment lender is going to be happy to keep lending you money because you've got good strong cash flow. We talk about in part 2 interest only loans. Interest only loans are an essential consideration for most investors because that's going to enable you to have higher cash flow, which is going to give you a lot more options. You can pay down debt, you can use that money for renovations, use it on your own mortgage, you can use it to buy more investments. We talk about how to accelerate your portfolio growth. We talk about 80% lending for investment properties. You know, at the time of writing and recording, most investment properties you need the 40% deposit through main banks. You actually can get around that. There's many different ways. Part 2, we talk essentially what is a successful investment, what does it look like. We cover a lot of proven property investment strategies, and we keep reminding ourselves, why are we doing this? I skipped over this part here, but at the beginning of the book, I ask you to set a goal around lifetime income, and we set a reason why we're putting ourselves through the turmoil of spending some late nights trawling through property websites, dealing with real estate agents, getting things under contract, fussing around. Like, why do we go to all this hassle? Part 3 is a mortgage optimization. We talk about how to utilize your position for maximum results. We talk about how to learn from other people's mistakes. There's no point in you making these mistakes. Other people have made them. We've got them in the book. We want to help you avoid making mistakes. There is quite easily like $100,000 mistakes detailed in this book. So if you want to avoid those mistakes, the $25 investment's pretty good. The 2 most common mistakes for established investors. We see a lot of investors that have built up portfolio over 20, 30 years that are kind of stuck, and it's a simple fix, but often there's a bit of hesitation to implement it simply because they haven't got the clarity. We talk about in part 3 what you should buy. We talk about the STAR principle and the 80-20 principle. We talk about the best place for you to buy an investment property. We talk about what should you buy, when should you buy, how should you buy. We talk about tips for negotiations and auctions. We talk about how to analyze property investment from different angles. I've got a nice mental model in here that simplifies it called the 6 hats. We talk about new builds and off the plans properties, the pros and cons, and then we move on to part 4 where we're talking about financial abundance, how to reach your passive income goal. A lot of people are going to want to rush ahead to this part, and by all means go for it. We talk about how buy and hold is slowing you down. We talk about how to get to $200,000 of passive income. We talk about subdivision and property development, and then part 5 we've got an action plan. We talk about it's time to buy an investment property, your property investing action plan for the next 90 days, and we touch a little bit on what mortgage advisors do and how to create your own investment philosophy. So above all of that, this is the contents page is quite long, And then we've got about 10 case studies in here. Some very, very interesting examples of normal people making 100,000, 200,000, 500,000 on some deals. And these case studies are from our private Facebook group from people that have purchased the Property Formula Workshop, which is a $3,000 course that we offer. So I'm going to go through this book bit by bit, and I know it might end up being 50 videos. So just subscribe.
My favorite thing about the workshop is how simple it is. So language is really easy to understand, so anyone with no property knowledge can understand what's going on.